Welcome to another edition of Risk and Return. I'm Charlie Gasparino from Fox News, from the New York Post, originally from the Bronx. I'm here with the daddy of data, my partner in crime. Now, this isn't crime. This is all in the up
This
and
is
up.
honest work for
This
crying
is
out loud.
honest work, but we like saying that. Bob Sloan, the founder and the CEO of S3 Partners, and no one knows enough. No one knows more about markets and the plumbing of it than Bob. And anyway, we're here every week to tell you guys how to make some money, particularly on trading, but also through some news that I bring to the table. Bob brings the expert Wall Street analysis, and I want to get right to it today, Bob. Last week we generated a lot of buzz with Lemonade. I've never heard of that stock before, but when you posted it and your thesis about it, it kind of took on a life of its own. I got a lot of what do you got going this week? Or let me return to Lemonade. What happened? I mean, have you followed it?
We have been following it, and it is a battleground stock. And it is one of these stocks where you're going to see, dramatic movement. It's just a question of when. So that's why we highlighted it. That's why it's a very volatile situation, because it is a battleground stock. And for the first time, you can really isolate what's moving the price day to day. That's why it's so great. And one of the things we wanted to talk about this week is we want to return to a stock, and we'll return to Lemonade next week, because I think it fits into what we want to talk about next week. We want to really use next week to talk about AI, GPU computing, and quantum. It's such a theme in the marketplace, but we really want to this week talk about, one, the power of short interest and why it's important. Two things like Lemonade. So we want to return to Dongfang Electric, which is a maker of turbine, and it's a maker of green energy infrastructure out in Hong Kong. And you can see on the chart, as we talked about, it was a crazy thing. There was a stock issuance. You would think that would be terrible and dilutive to the shareholders. What happens? The stock pops. This is the power of speculation, the power of retail around the world. And yet what happened, as you can see on the chart, is that short interest went up a lot selling into that pop. The stock falls, right? Short interest comes down a lot, meaning there's been a lot of short covering. And lo and behold, what happens? You see on the bottom right, you see the arrow on the bottom right, the stock popped about 20% in the last week. And we were calling this many, many, many days before the exchange in Hong Kong actually published short interest. So if you were following us, you could actually track the correlation between short interest rising and stock price, and short interest falling and stock price.
Amazing.
It's an amazing thing.
Yeah, and this is proprietary data to S3. You get it if you subscribe. You also get a taste of it if you listen to us. What do you got going this week?
Well, one of the things that's caught our attention is, first of all, gold, and just the parabolic rise.
It's just amazing. I'm just blown away.
It's incredible.
It reminds me. I mean, can it all be negative sentiment about the dollar or the debt? I mean, it seems to me there's a momentum play here too.
Well, that's one of the things we're going to talk about after we talk about the QQQ, because I think they're all related. But gold is interesting because if you look at the two most popular ETFs, right? One is the actual commodity GLD, the other is the miners. They're two different audiences. The commodity is actually the futures people. They're not stock investors, right? If you look at the miners, they're equity investors. So what's happened in the mining stock, right? Mining stock's gone up, but the actual share participation in the ETF has had an outflow. So people are in the miners, the equity people are saying, hey, this thing has gone up so much. We're out. We're outflow.
That's interesting. So they're out of the miners.
They're out of the mining
stocks.
They're redeeming in the ETF, right? And then you can see the gold miner ETF GDX. You can see the shares outstanding falling pretty dramatically. there's a redemption going on, right? People are basically getting out of their exposure because the commodity has gone so much. But if you look at the gold ETF, the actual commodity, which we'll pull up in a second, look what happened here, right? So price has gone parabolic, but you've seen the short interest as percentage of float, it's going up and down. But the point is that the outflow has been very minimal. People are still want the exposure to the underlying commodity, even though the equity investors have been redeeming on the miners. Now, what does that say? I think it just says it's a really schizophrenic market. There are two different investors in two different sets of instruments at totally juxtaposed. One side says, hey, this is crazy. It's gone up too much. The miners can't, whatever the ratios are and multiples, it makes no sense to be in the miners. And yet at the same time, you have people plowing money into the actual commodity. Sometimes the markets don't have a definitive answer. That's one.
I know that you're by the data, but I want to pick your brain. What's going on with gold? I mean, is this a bet against the dollar? I mean, what's going on here?
Charlie, sometimes you just don't know what you just don't know. And I think it's one of these times, we don't sit here to say, hey, we have an answer for everything all the time. Right. Just look at the data. And I just gave you two data points that are totally juxtaposed to one, right. Absolutely in opposite directions.
Yes, yes.
So it is very easy, I think, if you're classically trained, what do you think about a rise in gold? Safety, inflation, safe harbor, store of value. Those are the things that you as an investor say, you know what? It's telling me things, there's rough water ahead and maybe really rough water ahead. So I'm going to own gold. That's a sentiment. Yet the markets are screaming. Markets are way up. Sentiment's high. The AI space is on fire. You have a lot of different things going on in that particular segment. So I think gold is just the perfect explanation for where we are. It's a very heated environment, and maybe people are saying, you know what? I don't like hedges that have traditionally worked. I'm going to do things that maybe I'll do things that I haven't done in a while, which is own gold.
Interesting. What else?
If we look at the QQQ, and this goes back to a little bit about the discomfort in the marketplace. So you have, the QQQ is the top, the NASDAQ 100 basically.
Right.
But short interest has climbed to about 57 million shares, which is high. It represents about 9% of shares outstanding.
NASDAQ is at record highs though, right?
It is, and that's one of the reasons why it's high.
Right.
But also, why do people short QQQ? It's a hedge. And so they're not necessarily taking an outright naked call in the marketplace. They're trying to hedge other things in their portfolio. And this is really, the elevated short interest is telling you that there's hedging demand. People know that maybe this rally is kind of running out of steam until it's not, right? So, but this kind of hedging is consistent with late stage rally behavior, no doubt. It's caution. The market's climbing a wall of worry, and this is one of the representations of that wall of worry.
That's fascinating. There's so many negative sentiment data point. Am I missing something here?
No.
Are they building the? I mean, the market's went up. Trump says this is the place to invest, but it seems like we're getting data points that aren't so good.
Well, we had Tom Shapiro on, one of the great real estate investors around.
You did a great interview with him, sure.
Thank you. And what I asked him, I said, what's the data point you look at? What's important to you? You invest in everything up and down the vertical, all around, right? And he said, employment. So when, people see, hey, there's a lot of jobs being eliminated. And there's also something so disruptive around quantum computing, which, if you think about what quantum computing is, think about right now, we live in a world of ones and zeros in terms of code. What quantum is 0 through 8. So the capacity for computing is the difference between how many calculations can happen between 1 and 0, and then how many combinations are there of 0 and 8. It's almost infinite, the difference.
Right. So I mean, there's a lot of conflicting sources here in our economy. We should point out that you have potential drags in terms of tariffs, but this whole AI thing, it's just creating jobs right now.
And angst, right?
It's
Because
because
people they're unfamiliar with the technology. They don't know how to use it. You know,
but you also have to build out the centers. So there's middle class, working class jobs here.
well,
Right.
it's funny. Ask a computer science major from a top school if they can get a job.
No.
And going back to Tom's point about employment. So what does it say about the future of society when the best and the brightest are not getting the jobs that they, by right, if you graduate top computer science programming, you're not getting that job, you should get a job. You've paid the dues. And they're not, because AI is there. The entry-level job is being eliminated. But
electricians are getting jobs and plumbers are getting jobs.
Because,
and construction workers.
And this is a great point, Charlie. What's happened is that, hey, I can eliminate all this cost. And then I get the computing bill or the power bill and it all goes away. So what's happening is that, yes, you're getting rid of a cost here at the entry level, but downstream, all of a sudden, hey, wait a minute. The cost of putting AI is real. So wait a minute, we're not really getting all the benefit and productivity. So, you know, that might be the thing that puts a top to this particular market rally. I'm not calling it. I'm just saying it's a really interesting phenomenon because these things are so new, and thinking about them as a business person and thinking about how to use them, you know, what are the upstream and downstream effects of, for example, use AI, right? It doesn't mean that you outsource the computing code. It means you have to have someone monitoring what happens. Well, what happens if something bad happens? Oh, I have to make the logistics of moving power centers and moving the cloud and moving all these things around. So it just means you need more highly skilled people. Because even though you're eliminating lower skilled, you have to pay higher skills. So this is all embedded cost and how it actually plays out. And I think it's an uncertain thing. And, you know, in quantum, this is why these stocks like IonQ, for example, is just going nuts, because all of a sudden you're able to solve problems quickly that were just unsolvable, even with the harnessed parallel processing of something like an NVIDIA. This brings NVIDIA, you know, 100 times.
Oh yeah. Oh yeah.
And so I think that's what that's what gold is telling you, is that it's an angst about the insecurity and uncertainty, where 10 years ago, if you said, you know, in 10 years, if you graduated from Stanford as a comp sci major and you might not get a call back, you're crazy. But that's what's happening. And I think that kind of anxiety is happening at a lot of different levels. And I think that's one of the reasons why gold is up. I think gold is much more sentiment than anything else. You can read into it what you want. Maybe it's geopolitical. I think it's much more basic. I think to Tom's point, it comes down to employment and the threat to employment. And I think that's where it's being expressed.
And the anxiety is being expressed in gold.
Yeah.
And we don't know if this is a positive or negative for the economy. It's just impossible to tell.
100%. I mean, in my lifetime, I remember my grandmother, who was a very smart investor, by the way. She really was.
That's great.
I still have Krugerrands that she bought for me, because she was like, you know, I lived through some really bad times in the Depression. I've seen this. Here's a hedge. Here's gold. I still have them. So it's that kind of thinking that drives it. It's people are negative, and you can say, well, is that an encapsulation of market sentiment in terms of future events? Because we don't really know. There's no such thing as a driverless car for AI.
That's good. Great.
Okay, it is not. There's no such thing. But I think people think that,
Yeah.
and that's part of it, right? We don't quite understand. And I'm not saying I'm the person that does. I'm just saying these are my thoughts on the subject.
Well, it's why we can't plan. We can't. It's hard to like figure out this economy, and by virtue of that, the markets. I mean, the markets keep going up for lots of reasons, including, by the way, there are like half as many stocks publicly traded now as there were like 15 years ago, right, or something like that.
That's totally right.
Right? There's some bottom. There's a floor to some of this to a certain extent. You do have potential for more liquidity being pumped in the system with the Fed cutting rates. So you could see why that goes up, but you could see why people are saying, it's going up over here, but I'm just gonna hedge over here.
No, that's exactly right, Charlie. And so, one of the things that we've been covering on our show is the battleground stocks. Those stocks where the active long interest is equal to or almost equal to or just slightly above short interest.
Right.
And we're at a year-to-date high in number of battleground stocks. We have about 108 now. And the total market cap of that is about $50 billion. So it's not small, right? You have $50 billion worth of positioning every day where, depending on which way the market goes, the returns can be quite enormous. So for example, year to date, if you bought the 250, according to us, most shorted US equities, that basket is up 61% year to date.
Oh, wow.
Okay. If you bought those stocks that are battleground stocks, you're up 82%. And if you bought the ones that have skewed short, so where the short interest is more than long, you've more than doubled your money. It's up 125%. So what's that telling you? It's telling you that when an immovable object meets the inexorable force,
Right.
it doesn't stay that way for long. That stasis, it moves very quickly, because that's money in motion, probably has a 30 to 90-day life to it. And when the market moves, people move with it. And the market's been explosive on the upside, and you're seeing it. People are trying to play these stocks and bet against them, and they're getting smoked.
It's scary, scary stuff. But that's why we got you. Any more calls this week?
No, we want to talk about AI next week. It's really fascinating what's happening in terms of a lot of these stocks have, I'll call it deep fans and deep haters.
Oh, yeah.
And you can see it being expressed in the bets on the stocks. And we're going to tease that a little bit this week because we want to talk about something next week as these things play out.
Right. We should point out that I just saw some research today that if you took AI out of the economy right now, we'd probably have less than 1% growth.
Right. Because look at what's happening today with the money that is being raised and invested in OpenAI. It's an extraordinary sum of money by any standard, right? And then at the same time, you have First Brands and the private credit thing unraveling a little bit. Is that the first of many, or is that just an isolated incident?
I was going to ask you, what do you think? Listen, I've been reporting that there could be a crash in private equity now for 3 years. That's 3 years. And we thought maybe the colleges, the endowments, when they got squeezed by Trump on fines and withholding of federal aid, they're heavily invested in PE, that they might have to unwind their portfolios, take losses. We thought that would be an issue. But it seems like it never really is. One thing that people forget is that private equity has no real strict mark to market, right? It's like mark to a model.
Exactly right. I was going to say the same thing, which is, one of the beauties about private credit is there is no mark. So a crash in private credit is really a misnomer. It just means that there'd be less velocity of money. There'd be less investments. They're going to have to hold on to these things, work them out. Very hard to see all these things, I would say.
Right.
I don't think First Brands is just like this canary in the coal mine.
I think you're right. I just think that this is such a sort of unique market. One of the catalysts of the financial crisis, people say it was Lehman, but it was to a certain extent, but it was also mark to market accounting. So the minute they adopted that, and every bank had to literally mark their portfolio down, what they were holding on their balance sheet, which was a lot of subprime debt that was not that they couldn't offload to investors. They did a carry trade. They were keeping it on their balance sheet at 100 cents on the dollar or whatever, 90 cents on the dollar, and and taking the interest payment. So they were making a ton of money. But the minute I guess it was the Fed that started imposing mark to market accounting on the on every financial firm, particularly systemically important ones. Even that was systemically important. But you understand what I'm saying? The regulated banks. Um, you started like seeing that. That's when people started questioning whether Bear Stearns was and Lehman Brothers were insolvent. And as soon as they started, like, the Bear Stearns hedge funds that were heavily invested in subprime, when they went under, that took the subprime values down, and then you started seeing the cracks in the financial system occur. But if you don't have to do that, if you can just hold,
Right.
you might not have had a financial crisis.
Well, that's a different story for a different day. We
I
should
know,
invite some of the historians
no,
of
but
financial
it
crisis
is
to talk
it is
about that.
but it is related, isn't it? I mean, it was like we are not having. I mean, we keep calling for this private credit crisis, the Apollos and Blackstones, these companies getting crushed. But we leave out the key one of the fundamental reasons why the banks got crushed and the investment houses is because they employed mark to market accounting, and these guys simply don't have to do that. It's
Well, it's also because don't forget the Apollos are funded very differently
That's
than
true too.
a typical investment bank. It's more of an insurance model. It's more of a
Right.
Warren Buffett model where you're collecting this cash for a long period of time and then
Right.
you're deploying it. It's not rented capital
Right.
per se.
And it's
Per
not
se.
like
I mean, it's a part of it, but
it's not
it's very
leverage.
different.
It's not leverage 50 to 1 on a repo. That's right.
Well, all repos are leveraged, very, very, very high because the underlying collateral is supposed to be AAA, right?
Right.
And that's why you get that kind of leverage, or you get 1% haircut or 2% haircut. That's a
Yeah, and we should
50
point
to
out
100 times.
that all those AAAs started getting cut, and so that was another lever of the financial crisis.
That's right. But the Apollos, it's a very different funding model, very different, I think, capital deployment model. So I think comparing those two things isn't necessarily right, but it is one of those things where you look at the price of gold and say, what's this telling us? And it's telling us so many different things at the same time. It's very hard to make sense. It could be just that gold is going up and so people are buying it, period. It's just one of those things. And for whatever reason, it's got its moment in the sun. Maybe people are anti-dollar. Maybe they're don't like the drone slash, I'll call it, what would you call that? I would call it they don't like the fact that there are these at the periphery. It seems that people are challenging one another.
Interesting.
And gold is a measure of that fear, that all of a sudden you have drones over a NATO country. You have boats of Venezuelans being blown up. You have all these little
weird things.
They're not so little, but you have events that are seemingly less important that have huge significance, and that's why maybe gold was up.
Although, why didn't gold go through the roof when we had a president that was barely sentient?
It's a great question.
So that's why I'm questioning this.
It's a great question, but markets have a mind of their own, and I wish I had an answer to that, Charlie. I really don't. It's a great question.
I know, because Trump optically is volatile. Markets hate uncertainty. He seems uncertain, even though he's not really that uncertain. He's against wars. He backed off his crazy Liberation Day tariffs. He's actually much more predictable. Like, he carries a big stick. He talks a good game, then kind of backs off. Some people would call it taco.
Taco, right?
What was it called? Talk, whatever it was. I can't remember.
Trump always chickens out.
That was it. I don't want to say that, but that's not what I believe, just full disclosure. But you see what I'm saying? So there's part of that he's much more reliable than a guy that was, worked 2 hours a day and was asleep half the time and couldn't utter a sentence. So anyway, just remember that the markets get these things wrong.
Well, I also think the taco talk was pre-ran. I don't care. You can't say that this person isn't going to take action after that. That
Oh yes,
everything is after that. Everything's on the table. Period. So I don't.
And by the way, he bucked his own MAGA base.
Yeah.
People like my good friend Tucker Carlson were talking like, don't do it, could cause a war, and he did it anyway. I'm not saying I'm for it or against it. I'm just saying that that's kind of what he did.
Charlie, I got to tell you, one of the things I was listening to our last show, and I was thinking, you and I have such great chemistry.
Right.
It really comes along. And I was thinking, I had this crazy thought in my head. My dad loved jazz piano, and he was a student of jazz piano and jazz generally. He loved jazz. And, whether it was Earl Garner or Teddy Wilson, all these guys, it was constantly in our house, and he loved it. And you are Oscar Peterson. You play a lot of notes. You play them really well. Your left hand is awesome. Your right hand is awesome. And I'm Count Basie. I just pop in, play a couple.
I want to be counted up.
And we just pop in, and that's why, but it works.
Well, listen,
mesh.
Here's one thing about our show I think our viewers should appreciate is that there's not a lot of ego here between us. We both do our jobs. We do it well. I know what I know. I know what I don't know. I defer to you. You defer to me. And that's how we're going to get through this. And that's why that's how we add value. I don't add value by being by being Mr. Know-it-all.
That's right.
And you neither do you. But I mean, it is, we do bring a skill set to this that I think people are starting to appreciate based on the numbers that we're getting. Let me go through some headlines of mine before we wrap this thing up. Are you done with your babies?
We are done.
Interesting today is, when this thing airs, it'll be a couple of days, but I moved the stock. Today is Wednesday. I moved the stock of Warner Brothers Discovery in the most bizarre way. So I reported that private equity is going to help fund a potential bid by David Ellison of Skydance to buy Warner Bros. Discovery, which is a huge, as you know, a huge media company. It's one of the best right now. Has the best studio, Warner Brothers, with huge hits. The third largest streaming service. I think it's first. It's Netflix. It's Amazon. It's HBO Max. It's run by a guy named David Zaslav, a longtime media CEO. I know him well, and it's doing very well right now. And a month ago, it was leaked that David Ellison, Larry Ellison's son, so he's got money, runs this independent studio that just bought Paramount for $8 billion. He just plunked down $8 billion for that. He just spent another $150 million to get Bari Weiss to come over.
Let's talk about that.
But he spent that money, and now he wants to go after Warner Brothers, which would be a $60 billion deal. So here's what I did. I reported, and it's all true, that he's seeking private equity money to do it. And Apollo, they're in talks with Apollo. I think people at Blackstone are thinking about it, although they're kind of negative at this point, but they might do it later. Stock pops on the news. I mean, like up $3. Warner Bros. Discovery on the headline when it first broke, and then it shoots all the way down again as they read past the third paragraph and realized that one of the reasons why they're looking for outside money is that maybe Larry Ellison, who was thought to be sugar daddy, was going to was not going to sell $60 billion of his Oracle stock to fund the WDBD purchase. So it was really a kind of crazy day. And this is a crazy company. I mean, I'm just going to say this. Whether David Ellison, and by the way, he's a good producer. I think we don't know is whether he's a good businessman. Paramount was not the greatest media company to buy. It was there, but it's middling studio, old legacy assets like CBS. I mean, I guess you got football, but you got like a horrendous news division that's not horrendous, but very leftist news division that's bringing a lot of unwanted attention. Colbert, which they lose 50-40 million dollars on. And so he goes out, and to add to this, he spent not only does he like look to buy Warner Brothers Discovery, which by the way owns CNN, so you can see how he wants to merge CNN with CBS. Um, he goes and he buys the Free Press, which is a right of center news site that's run by a journalist named Bari Weiss, who it's a woman, Bari, who worked for a time at the Journal on the editorial page, worked on the editorial page of the Times. Not known as a great, like a huge journalist, but smart. I just, she's like a thinker. She did create a good product, but he spends $150 million on this thing, which produces revenues of 15 million. And
She's
who
very
knows?
brave, though. You have to hand it to her. She was very brave doing what she did, not
At
knowing what her
times,
future was at the times. Well, you got to hand it to her. She was very brave to do what she did. She staked out her own thing.
yeah.
She left what was a predictable life for her and made a new one. And my hat's off to people like that, because she took a lot of flack when she left. She did.
She did. Others did as well, and didn't cash out at 150 million. Now, maybe.
Well, but she took the risk, Charlie. I mean, come on. You
Yeah,
can't fault her for that.
I'm not faulting her. I'm just saying that this thing is not worth 150 million. All right, let's just get
so
it.
what? So
It's
what?
not. It's not. No, but it makes it. Listen, the story's less about her. It's about David Ellison.
Well, she felt that she's worth $150 million because
She's not.
but wait a minute.
She's not.
Putting her at CBS.
She's
Now,
not.
you don't know, by the way, if that's $150 million cash
no,
settlement, or that's $150 million, $1 million a time for 150 years. You don't know that.
Listen, you're right. And by the way, there's a cash out, there's a cash payment, there's performance goals and
All
stock.
that. So maybe the sum total is, if she knocks it out of the park, it's 150 million bucks, but not today. So,
but Bob, she's never run a TV network. Okay, she doesn't know. I mean, she's a smart person. She, I mean, with all due respect, how much does it really take to tell some woke producer at 60 Minutes, you know what? If you cut out Kamala Harris's word salad, that's not good journalism.
but I think it's different. I think, and look, this is your neck of the woods, okay, not mine. So I'm just going to say one thing. She took the risk of being canceled. I think that's fair, but I think she did it in a way that is rare. She went out and founded her own company with a lot of headwind, not easy doing what she did. And now, she's the editor-in-chief of CBS News. I mean, that's a pretty incredible story.
But I know, but that's the whole thing. I mean, when I think about this, I think, more power to her. I'm a viewer. I read the Free Press, and I have her her podcast. I listen to it all the time, honestly. I really enjoy it. It's just not worth 150 million. It's not by any stretch of the imagination. And it makes me think that David Ellison is just not ready for prime time. And it's sort of a tell on this Warner Brothers Discovery bid. I mean, it's the weirdest thing. A month ago, someone leaks out that he's gonna do this. Pay all cash, by the way, for the whole thing. This is, by the way, it's in the process, this company, of dividing into two: a streaming and a studio, and the cable properties. And the streaming and the studio won't have any debt. The cable property will have minimal debt. The other half will. They're doing this because they want the growth area to basically maybe attract a suitor, maybe Netflix. But my point is that that thing gets leaked. Then they leak out that they're thinking of paying $20 to $22 a share, which David Zaslav over at Warner Brothers Discovery is like, all right, try $32 a share. And it's just the way this is handled, Bob, makes me think he's not ready for prime time.
Or maybe it's a little more sophisticated message. Maybe it's, hey, we want people to say what they think, and we're willing to way overpay because we think it's so underserved as a product that we're going to pick the person that we think can do that. And, that's their right to do that. If that's the price of honesty and you want to say, look, this is what we want, then
By the way, I'm looking at it a little differently in the
Okay.
sense that the way this Warner Bros. Discovery deal, take Bari Weiss out of it, it makes me think that on top of the fact that he way overpaid for what he needs for her and what the business is worth, makes me think that this guy is just, he's just throwing a lot of money around. When I see that, I start thinking, listen, I know a lot of rich people as you do. Jeff Bezos does not like throwing money at the Washington Post.
Well, he
Too
bought
few,
the Washington Post for a lot less.
right? But then think
For
about what he
100,
did.
I think it was $100 million. Well, you can fact check me on that, but I'm pretty
Yeah,
sure.
it was pretty. It was, compared to what Elon bought to Twitter for, it was a lot less.
A lot
But
less.
it wasn't $1 billion deal. But what I'm saying is, he's made it clear that he's just not going to spend money on this thing. And that's why the Post went through all that restructuring. So really, and he's rich, and he's like as rich, almost as rich as Larios and David's father, not David. Um, the balance sheet of Paramount Skydance right now has $2 billion in cash. They can't really fund these things.
Yeah.
I'm just saying that, if you're a public company, which he is, you got to ask, why didn't they go private? They're a public company. They got Redbird backing them up. If you're a public company,
No, that's a good question.
what you should not be overspending for stuff. And it just, when you do, that's alarm bells in my view. And maybe I'm wrong, but I'm just saying that that's something that I look at as a veteran reporter. One more story for me is TikTok. Do you ever think TikTok will go public? It should, shouldn't it? This new US TikTok,
I hope it does.
it won't. Here's the problem with TikTok, and it's something I've been doing reporting on. It's the president that determines whether it complies with this ban law. Remember, the ban law says, bipartisan law says, if you don't divorce it from Chinese control, this thing is illegal. And if you're a private entity that funds it, you could be held for gazillions of dollars in damages. So you would think that because of the ban, because Trump says it's comporting with law, that everybody is on board and saying, yes, this is great. It's got a $15 billion valuation. We can IPO this and probably get twice as much money, right?
Sure.
It's not going to happen because it's the president that determines whether it comports with law. So if Gavin Newsom got in there, my good buddy, or J.B. Pritzker, Democrats who hate MAGA, and wanted to stick it to all the MAGA investors in this thing, they could turn around and say, well, this thing is still got Chinese control. The Chinese still own piece. Well, by the way, you're leasing the algorithm from ByteDance, the Chinese company. They could still theoretically spy on us. We think this is illegal. So disclosing that in an IPO document will be insane. And that's why I hear they're not going to do this.
Well, that's why I was saying I hope it does go public, because there'd be some scrutiny and you'd have to make these disclosures and you'd have to understand really what's behind such an influential technology.
Yeah, and get all the downside in a very legal way that we'd be able to discuss it. But it's not going to happen, from what I understand.
Like I said, I'm a fan. I wish it would go public because I think it needs the sunlight. Yeah, it sure does.
I'm with you on that. That's it for my stories this week. Any parting thoughts?
We are going to talk a lot about AI stocks next week.
Okay.
Particularly, particularly quantum and how it relates to GPU stocks, so like NVIDIA, to AI software, like some of the Magnificent Seven. And there's a whole continuum that's a huge thematic basket in the marketplace. We have the best data on it. We're going to be writing about it all week. We're going to be dropping a few things, and we'll talk about it next week. It's a big theme in the marketplace, almost as big as gold.
All right, but definitely, I loved your stuff on gold, and I agree. There's a lot of hair on this gold bug, so to speak.
It is. It feels to me a little overbought, but that's just me. And
Well,
by
you
the
know
way,
what?
that's the data. That's not investment advice. That's just
Well, what did Goldman say? By next year, 4,900? That suggests a pullback because it's at 4,000 now,
4,000. Well,
right? Doesn't that suggest some sort of correction and then back up?
well, 4,900 an ounce. No, they think it's going to rally 20%, right?
So
So
where is it now? Where is it right now?
about $4,000.
Okay, so it's just, I mean, how much did it rally over the last month?
It's up like 50%. Almost. It's actually
It's-
some of these things are up almost 100%.
So it doubled almost. I
Almost.
don't think so. What they're saying is it's not going to double again. It's
No, but it's going to still rise. So
right, but there'll be pullbacks along the way. That's the way I took that. Like, there'll be just. I mean, there's going to be some profit taken here
yeah,
at some point. So if you get in now, just be prepared for that.
yeah. Like we were talking about earlier at the top of the show, the futures pit is long this commodity. The futures people, the commodity folks, the people that have exposure to the actual metal are long it, and the people that have it through mining stocks, et cetera, like a secondary exposure, they're starting to redeem.
By the
So
way, I'm
there's a
long
true
at
battle here.
I'm long at the chain around my neck with the little Christ head on. Just FYI, as every Italian American has. Um, that's it for me. This is Charlie Gasparino signing off for Risk and Return with my partner Bob Sloan. See you guys next week with a deep dive into AI.